We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Anthony Milewski, chairman of Nickel 28 and founder of Carbon Advisors. How are you today, Anthony?
Great, Tom. Always appreciate you having me on. Looking forward to chatting today.
Excellent to have you back. And of course, the last time we spoke, we talked a lot about carbon credits. And you know, this is something that at the time really didn't get much attention. Over the last year, it has just exploded. And you know, we've really seen this huge growth in the industry. So for those that aren't familiar, how much have carbon credits, let's say, appreciated since that time? And if you could give us kind of an overview of how carbon credits work.
Yeah, sure. No, thanks a lot. Yeah, I mean, it's been really crazy. So, you know, when we spoke a year ago or a little over a year ago, a lot of the credits that we were talking about were trading at 75, 85 cents. Those credits are literally trading, some of them at $14, $13, $14 today. So this market has already been transformed, and that's the voluntary market. Just as a reminder for the listeners, there are really two carbon markets. There's the regulated market and the voluntary market. The regulated markets, you know, they're in California and Europe. There's in the Northeast, there's REGIs, EAUs. And those markets are really about widget makers in a given jurisdiction offsetting as mandated by law, you know, their carbon footprints. And that's very heavily regulated thing, and they trade like water. I mean, you know, these are exchange traded securities basically. You know, you trade them through Morgan Stanley with an ISDA. There are ETFs like KRBN. That's one market, and that market is separate and apart from the market that we talked about a year ago, which is the voluntary market. And the voluntary market is the market that whenever you go buy an airline ticket and it says for $7.95, you can offset your carbon footprint. Check here. That's the voluntary market. And that market has been transformed by a bunch of factors. One of them simply being that COVID and the liquidity that came into the system as a result of the various bills around the world was focused on, you know, restructuring the economy around, you know, energy and green energy transition. And so that brought our carbon footprints into focus. And so you've seen almost every company on the S&P, every major company in the world set targets for being carbon neutral. And those targets not mandated by governments, but instead by their own voluntary actions means that they have started to enter into the voluntary market and buy those credits. And so that's just kind of been an amazing transformation of the markets, and it's sent the credits really moving on a trajectory upward. And so, you know, you've got a long way to go still, but they've moved materially since we spoke a year ago.
So when we think about the differences between the regulated and the voluntary system, could this start to affect energy prices? And if those costs get out of hand, could we see the industry somehow turn away from the system?
Well, they're two very separate things. And so if something is prescribed by law in a jurisdiction, I mean, that's really between the state of California and emitters. And so, you know, that is legislated and regulated. And so it's, you know, you're going to have sort of a view on the politics of California or the EU or of a given country that has a regulated scheme. And that's hard to do because each jurisdiction has its own set of individual drivers. I will say, though, that the voluntary market, a little bit different because as we discussed, people are opting into the scheme. Although once you opt in, you can no longer opt out. A voluntary commitment becomes a mandatory commitment in terms of, you know, endowments and BlackRocks of the world owning you. Yeah, it really can actually have an impact over time on prices. But I think that's the point. Remember, the point of carbon credits, in particular voluntary credits, is it's a transition to a world where you're actually consuming less carbon. And so it's this intermediate step. And so the notion is and was that if it cost more for you to produce that widget or do the thing that you're going to do because you're offsetting it with a carbon credit, then over time, the cost of that will, you know, it will influence you to either change the technology or change your actions. And so I think the very point of carbon credits is that the emission of carbon costs more, so that through time, people's actions either change or the technology or the way that they're doing something changes as to emit less carbon. So that's actually the very point. And I think we see this with metals. We see this with all sorts of different things. If you slap on a credit to offset it, just by the nature of the thing, it's going to cost more. I mean, it's a form of a tax, if you want to think of it that way.
Mm-hmm. So, Anthony, when we think about, let's say, that incentive to change how people are actually doing things, how long do you think that system can support that? Like, is it possible that mining companies, for example, would just keep producing the way that they are and just keep buying carbon credits to offset the carbon that they're emitting?
Look, anything is possible, but I think it's unlikely. And the reason is that, carbon will continue to cost more and more and more. And then, that burden will cause you to change your fleet. So let's just use an example. You're a mining fleet today, and maybe you use diesel. All your machinery is run on diesel. Hydrogen, a hydrogen fleet, which I think is probably the fleet of the future, possibly electric, depending on the cost of electricity and where that electricity comes from. But that's probably more expensive than diesel today. However, if you layer in the cost of a carbon credit, I think what happens is all of a sudden thinking about a hydrogen closed cell system becomes much more interesting. So it's really the nature of it. And the thing which I think is interesting about the voluntary markets is the best credits are primarily nature-based solutions credits, which means, what we're seeing are reforestation projects, mitigation projects where you're preventing deforestation. And so, we are really using these voluntary credits for enhancement and preservation of ecosystems around the world. And so there is a lot of benefit to the communities and really to the world for this system. And so I think it's one of the things which also makes it kind of unique.
So you gave us a couple examples there of the types of projects that give companies carbon credits. So could you walk us through how a company or an entity starts to produce carbon credits and what kind of projects that actually produce credits?
So let's start on the other side first, because I think it's easier. So let's pretend you're an emitter. Let's pretend you're a mining company. Mm-hmm. There are any number of consultants out there that can come in and they can tell you, you have a carbon footprint of X, and there are different parameters. Like, are you including are you including the footprint from your executives flying around the world? Like, what do you include in that? But that's just a basket. So you figure that out and you come up with a number. And then what you do is you go into the voluntary market, because we're assuming these are voluntary offsets. You go into the voluntary market and you purchase an equal amount of credits. Let's say that you have 100,000 tons of carbon each year you need to offset. So then you go in and you buy 100,000 credits, let's say, and then you extinguish those credits. And that's the critical kind of point here. So, what happens is by buying the credits, you've not offset your footprint. You don't offset the footprint until you actually extinguish the credits. Mm-hmm. And if you look at the carbon ecosystem, what happened was when it emerged kind of 15 years ago, it was a complete disaster. There were no set standards. There were scams. People were off buying forests. They showed up, the forest wasn't there. I mean, every manner of disaster happened. And what emerged from that are, systems, and in particular, Verra is one of the key standards. I think something like 75 or 80% of all credits issued this year are going to be Verra credits. So what you have then is a common standard such that a metric ton of carbon is a metric ton of carbon. And, you have a project which gets registered. We can talk about that in a minute, but it gets registered. So now that credit is registered under Verra, and Verra is kind of the trusted name. And when you buy that credit as an emitter, you're a mining company in this example, and you retire that credit on the Verra registry, you can actually say, these 100,000 credits are retired for the nickel 28 2020 carbon footprint. In fact, nickel 28 did that carbon footprint. And then anyone can go and see that indeed those credits have been retired. And let's be clear. If you buy the credits, you can sell them on. But if you retire the credits, you can no longer sell those credits on. And so that's a distinction, because obviously there's speculators in the market, there's emitters, there's sort of all sorts of market participants, but it doesn't really become official until you actually retire the credit. So that's on the side of the emitter. If you want to flip that over and go over to like how are credits created, that's something different. And there are different types of credits, and the credits which I think are, probably the most interesting and the most important are nature-based solution credits. And if you think about it, it's there's a bunch of different varieties, but in its most simple form, you could have reforestation. You could have a forest that's going to be cut down, and you're going to prevent it from being cut down. Additionality there being that you're preventing the trees from cutting down. You can have wildlife sanctuaries. There are blue credits, which are about saving mangroves or kelp in the forest. So these are all nature-based credits that somehow are preserving nature in a way that is helping to capture carbon. And effectively what happens is you put together a scientific plan, and through various guidelines and rules, you measure the carbon, they look at the biodiversity and all these factors. And over the course of maybe a year or two, that plan is written, it's submitted to Verra. And then ultimately, whatever mitigation you're going to take, you have to put that in place and then execute on the plan. And then, going forward, you have to kind of reconfirm each year that you're doing what you said. And then those credits are issued on an annual basis. So it's really interesting because, what we see today is nature-based solutions credits for a good new vintage 2021, 2020 vintage are trading around $14.50. And, you probably need to plant all the arable land in the world like 4 times over to offset the world's carbon footprint. In other words, you can't do it. And so what I think is going to happen here is you're going to see the price of the voluntary market go materially higher until it reaches the point of carbon capture, which is mechanical carbon capture. And, depending on who you believe, that's anywhere from $60 to $300 a metric ton. Just depends on the type of technology. And so I think what happens is nature-based solutions and some of these other voluntary credit solutions will get us to kind of a $50 or $60 carbon price. And then from there, you're really going to need mechanical carbon capture to come in to fill the stopgap if we're going to meet all the commitments that have been made by the major companies around the world for 2030 and 2040 and 2050.
So as you say, that price will move up to the point where it incentivizes mechanical carbon capture, right?
That's correct. And I think I at least right now, my view is that you won't see voluntary credits eclipse regulated markets. So, the EAU, which is the European offset, is kind of trading at or near $100. Think something like, I have to look, but some 80 euros or something right now, near all-time highs. So I think that even though they're totally 2 separate markets, I think that acts as a ceiling into the markets. And so what you'll see is you won't see the voluntary market eclipse the regulated market, but you're going to see the voluntary market get dragged higher. Because remember, one of the things that I think emitters are trying to avoid here is becoming all regulated. Mm-hmm. Because all of a sudden, if everybody in the world was regulated, then you have to be buying offsets at 80 euros or whatever they're trading at today. So there's also this kind of arbitrage there. And so emitters are really keen, of course, to be buying $14 credits or whatever the number is. And this also kind of dovetails in not only to consumers demanding that companies be greener and think about their offset and the impact that they have on the environment, but it's also being demanded by major funds and endowments who won't invest or who will withhold investment if there's not a clear path towards net zero or something approaching that in the coming decades. And so it's a big groundswell. And I think what it means is that there's a huge pressure on the voluntary markets. And, there's kind of, depending on the type of project, an 18 to 36 month delay from I just came up with a new project to actually executing the project. And that can even be 5 years in the case of reforestation until you're actually getting credits delivered. And so no one really foresaw with great clarity on the developer side the wave of demand that was going to come into the market. And I think that means that the market's going to be really tight at a minimum for 3 to 5 years. And, I don't know if you followed it, Tom, but a really interesting development as recently as the last few months has been this new crypto token, KlimaDAO, and I'm probably saying it wrong. And what they've done is, depending on who you kind of believe, they've gone out and bought maybe 20 million credits. I mean, once again, it's not clear, but they've bought a huge number of Vera and other types of credits. And then they have retired those credits, and they've been largely responsible as well for helping that price move forward. So in addition to industry buying, in addition to speculators buying, now you have a cryptocurrency, a token, come in and start to buy and retire credits, which is unique because like if a hedge fund buys $10 million of credits, you know for sure that they just want to sell them on, like that's their business. But this token is really interesting because what they've done is they've bought the credits and retired the credits. And so they've taken that supply out of the market. And so it's really also kind of helping to transform the market and really push it higher.
So what do you think is their end goal? If they're buying the credits and retiring, are they just trying to push that market higher?
I mean, I think in their view, you're offsetting your. I mean, I can't speak for them. I don't even know. It's a decentralized token, so I don't. There's just a website. There's no one to even talk to. But it seems to me that is their objective. Actually, is that if you're a holder of a token, hypothetically, you've offset that 1 metric ton. Like that's kind of interesting. And Mark Cuban was quoted as saying he was going to buy $50,000 of this thing a week, which I think just brings more attention to it. And in so doing, by retiring those credits, like hypothetically, if you own a credit, you've offset like 1 metric ton of carbon. Now, I think it's more nuanced than that because, and Vera actually came out and talked about this. And usually when you retire a credit, you can no longer transfer that credit on, but the token is actually retired the credit and they're continuing to be transferred. So look, I have no idea. I'm not, unfortunately, a crypto bro. I probably wouldn't be here. I'd be flying on a jet somewhere, right? But what I can see is that it has brought tremendous demand into the market, and it's really cleaned out all the old vintages, and it's moved the thing higher. Look at carbon streaming run by Justin Cochran. They did Rimbaraya at $4. Those credits are trading as high as $15.60 now. Mm-hmm. I mean, the NPV of that thing is worth more than the entire market cap. So. And I know that Josh over at Base, same thing. The market is moving so quickly that I don't know how high it's going to go, but certainly this crypto coin, and there's a handful of other ones in the works, are helping to do that because they're not creating an overhang. If you buy the credit and hold it, someone can sell it. But if you buy it and retire it, you can never unretire a credit.
Right. So do you think that the association of NFTs as well with carbon credits, some recently I saw there was one that sold for $70,000 and there's another one trading as high as $310,000.
This is an insanity. Okay.
Yeah.
This is such an insanity. So, so I have to tell you about this thing. So okay, it's a Rimbaraya credit. Mm-hmm. The Rimbaraya credit today, if you go in, depending on the vintage meaning the year the credit was created. So that credit is today trading anywhere between $14 and $16. The newer credits are worth more. We get into that, but that's just a fact. So, and you can go buy that credit. So they paid $14.50 for a single Rimbaraya credit. Then they sell it on for $70,000. And then I don't know if you know this, but they've taken that credit, they've created an NFT. And the last time I looked, it was for sale for $312,000. I mean, this is madness. I don't know. I mean, that's something separate and apart than the carbon market. And I think it's great because it brings attention and it gets people to think about maybe ways that they could participate in the carbon market. But, I just don't. It's something separate and apart from the carbon market. Unless, of course, I will tell you, the nuance here is, if the success of that NFT ultimately means that people come into the market and buy more credits, then it helps the voluntary market because you take the demand, you retire the credit, and it moves the market forward. There are only so many credits; it's finite. So it's interesting. But I think one of the most exciting things about this is you're using capitalism to actually make money, but you're saving the forest at the same time. You're really protecting hundreds of thousands of acres from deforestation or reforestation or whatever the nature-based solution is. And so I think that's a pretty exciting aspect of it. I think it really speaks to retail and younger people who, during the course of COVID, have become interested in trading. I think crypto's done a great, fantastic job of introducing people to capital markets in their own and various different forms. And I think one of the things which I believe is going to be highly attractive to that audience is just, hey, look, we can make money on this. And by the way, we're like reforesting, Indonesia, or we got a project in the Amazon, or whatever the thing is. And so I think that's something which is very unique to this whole space.
Do you think, though, that the advent of NFTs in this space takes away some of the credibility of it? Like, are some the speculation that is getting wrapped up in the NFT space? Do you think that takes away from some of the legitimacy of the carbon credit system?
No, it's completely not. It's not an issue. I mean, like, someone creates an NFT that has nothing to do with the underlying veracity of the credit. I mean, Vera is the standard. So a Vera credit is a Vera credit. What someone does with that credit is their own business. And if anything, if that credit sells, I think it's on auction for $312,000. So, like, if someone pays that, like, I don't understand that, but if someone pays that, I think, there'll be 100 articles written about it, and it will bring just more attention to carbon credits. And ultimately, I think that's a good thing. But I think the NFT thing's a bit of a distraction. That has no real impact on my investment case or my investment ideas. The token, the KlimaDAO, I'm probably saying it wrong, but that token, I think, is much more relevant because that token is actually in the market buying large quantities of credits and then retiring those credits. So that's a material event in the carbon market. The NFT thing is like a PR stunt, and like, if someone wants to do that, that's great. But I think it just is just a non-event really for what's happening, and it doesn't really determine what things look like going forward.
So on the other side of that, Anthony, how does China's buy into the system legitimize it as well? Do you think that that they're showing their intent of being more environmentally conscious and trying to think about the environment a bit more? Do you think that legitimizes it as well?
Well, look, I mean, China's regulated carbon credit market is massive. I mean, they launched a program and it's huge, and so clearly they're thinking about it too. I've been on the record saying that I actually think that that China has played an impressive global leadership role in environmental policy through pushing electric vehicles. Slightly different topic, but I think that they've played a huge role in that. I think we've seen demand out of Asia. There are instances recently of Hong Kong Stock Exchange listed companies offsetting their carbon footprint. So, no country is perfect, not a single one of them. It includes China, includes America, Canada. But I would say that, environmental policy in China is moving things forward. They've obviously sanctioned it. If you're going to have a Hong Kong listed company offset its carbon footprint, and they've created domestic regulated carbon markets. So from my perspective, although I don't participate in that domestic market, I don't even know if I could legally, I believe that that's bullish ultimately for everyone. And and I think they've taken a lead in electric vehicles, and maybe they'll step up in carbon as well, like, yet to be seen.
So when we take the mining example that we talked about earlier, does it matter what a company is actually mining? Like, let's say if a company's goal is to mine nickel for EV batteries, does it still need to offset their emissions with the carbon credits?
Yeah, absolutely. Because like the very act of doing anything, the act of this interview right now, there's a carbon footprint associated with it. I don't know what it is, but it's, there is an act of doing it. And so if you are burning hydrocarbons to dig a ton of nickel out of the ground, then that needs to be offset. And hopefully what happens, and we kind of spoke to this earlier, but as prices rise, hopefully what will happen is the cost of offsetting, the cost of that carbon credit will become punitive, and you will decide that a better option than diesel in this example would be hydrogen, right, or electric. So there's no question that all mines everywhere are going to have to think about this. And in fact, you have a lot of the big fund managers talking about it. And there's things they can also do. Like, there's a project in Canada, Turn Again. And I also think Mark Selby's project, Canada Nickel. No, I'm not sure. Mark Selby, he runs a mining company or an exploration company in Canada as well. And I know he's talking about it, but the sequestration of carbon in tailings. And so what I'm getting at is potentially as we move forward, when people are actually building mines, the way in which they build those mines will take into account the possibility of sequestering carbon, and they'll probably design them as well in a more friendly, automated way using technologies that are less carbon intensive. And so this is 100% kind of the wave of the future. Now, the rollout of this is going to take a decade, but you already have gold miners in West Africa looking at being completely autonomous, electric. That's only going to accelerate, and a higher carbon price is great, because a higher carbon price is going to get everyone focused on reducing the carbon footprint of whatever widget it is that they make or sell.
Mm-hmm. So before we move off of the carbon topic, is there anything else that you think that we need to talk about before we do?
No, I mean, look, I just think that this is one of the most interesting trades I've ever seen, because unlike gold or copper or nickel or any commodity that we've talked about in the past, every single person and company on this planet has a footprint. You just do. And, your carbon footprint is anywhere from 7 to 10 metric tons a year annually. Personally, that's probably your footprint. And we are consuming more resources and emitting more carbon than is healthy for the earth. And so this market is exploding. It's doubled last year, doubled on the year before. It will double next year. And it's going to be a massive market. Some people think it's going to rival hydrocarbon market. And so I think investors who listen to this have to be thinking about this market. Today, there are only a handful of ways to play it. Like I said, carbon streaming is one. KRBN, it's an ETF in the US, is another great, safe way. Base carbon, I think they're going public Q2 next year. So there's only a handful of ways to play. But notwithstanding that, I think you just have to be thinking about how it's going to impact your portfolio, how the businesses that you are invested in are going to deal with this. Because if they don't deal with it, certain fund managers are not going to be allowed to invest in them. So this is a major theme that we all need to think about as investors as well, not just investing directly in it, but also how it's going to impact the companies that we're long. So, we'll talk about this again in 6 months, and it'll be even more developed and advanced, but it's really interesting and people should focus on it.
Absolutely. It's just a huge growth story. And of course, as trying to be a contrarian investor, it's something that we need to kind of focus on, is these smaller stories that we'll be developing and that we can see a clear path forward for.
Yeah, look, my view is that, if there's a big, massive recession or something like that, anything can happen. But I think that the voluntary markets are going to see $50, $60, $70 a ton. They're at 14 today. They were at 85 cents, a year ago. So I think that is the order of magnitude that's coming, and it's going to be a mega story over the next 24 months, and people should focus on it.
Mm-hmm. So as we think about the growth of the nickel demand for batteries in general, how much nickel demand is expected to grow? Like, how much is it expected to grow by over the next, say, decade alone?
Well, it depends on which analyst, what model you're using for the adoption of electric vehicles. And also it depends, like one of the things, Tom, that's kind of changed in the last 12 months is that, there's a new story, a new narrative that Tesla's really pushed in the market around LFP, lithium phosphate batteries. So it's an iron battery, lithium iron phosphate battery. They've said effectively that on less expensive cars where you need shorter range, they're trying to use those batteries. Mm-hmm. To what extent will they be successful? I don't know, but I think that's changed the model for some analysts. But I think if you assume even a mixed kind of a mixed bag where you have some of the NCA, some of the NMC, and some of the LFP batteries, and you mix them and blend them, it seems like you're still going to need 25% more production on a conservative basis than you have today, right? And the challenge with nickel is there's not really such a thing as a cheap nickel mine. I mean, these large nickel mines, even let's talk about nickel sulfide for a second. The Turnigans and the Dumonts in Canada, they're all $1 to $3 billion capex, and those are nickel sulfides. Let's not even for a second talk about some of these nickel laterite HPAL projects, which have been as much as 7, 8, 10, $12 billion Goro or whatever, 8 billion, whatever it ended up being, billions of dollars over what they suggested as the initial capex. So why am I saying all this? I just don't see any major mines under construction at the moment. And so what I don't really know or have a view on is, even if we're really conservative around demand, future demand, I don't know where the nickel is going to come from. If you start building Dumont today, which is shovel ready, and I think Goldman is running a process for Waterton on it, you start running that process today, like there's probably not a mine there for 4 years, realistically, maybe 5. So it's a big question mark. And we're talking about nickel right now, but cobalt, lithium, all these battery metal energy transition kind of metals. I just think that they're not being built. Maybe lithium is an exception. There's plenty of lithium money right now. But what happened, and Tom, we can talk about this another time, but what happened was in 08 and 09, hedge funds and fund managers really changed. And they changed from being able to own a liquid stocks and take long-term views to being heavily driven by liquidity. And so you look at Citadel, Millennium, these guys are sitting inside of pods, and there's a risk manager sitting over top of them, and they own stocks for days and hours and weeks. They don't own them for years. People get paid mark to market annually. They don't own these stocks for years. Basically, people only rent mining stocks. Like I'm not really aware of too many owners of mining stocks, sadly. And I think what that means is we're probably setting the stage for a mega bull market from lack of investment. You have the BlackRocks of the world forcing BHP and Rio to push out dividends and not invest in new production. Well, yeah, that's all fine and well because they're backward looking at the last cycle when they destroyed value through M&A. But let's take a breath here and look forward. Well, what happens if BHP and Rio and all these guys don't spend any money on their pipeline? Well, I'll tell you what's going to happen. And we will wake up someday, might be tomorrow, might be in 2 years, might be in 7 years, or say, holy crap, we have a real problem on our hands. And, the market, like if you're a hedge fund manager, why do you care about mining? You can chase tech, you can chase 100 other things that are more liquid too, by the way, and sexier. And so you're not that interested in owning our space. And ultimately that sets the stage for the mega bull market, not a super cycle, because that was really China specific. And I don't like that term, but something big, and it's coming eventually just simply from lack of investment.
So Anthony, when we talk about the nickel battery chemistry, obviously you mentioned cobalt is a big component of that. Does the production of cobalt affect the possible production curve of these types of batteries as well? And considering that the majority of cobalt comes from the DRC, does that present a major challenge to producing a nickel cobalt battery?
I don't believe so, right? There is a lot of cobalt in the DRC. And the fact of the matter is, you can organize that. Like you can actually set up fences you could create the Kimberley process like they've done for diamonds, or in certain parts of Africa with alluvial diamonds, you've got 2 chain link fences, dogs in between. I mean, you could manage it and give everyone a badge. So that just costs money. So I think that you could dramatically alter the way that cobalt is extracted out of the DRC. So I'm not really worried there about it being short. It's more a function of price. The other thing I would note is, from what I've read and seen and talked with guys, that 811, that 811 battery chemistry, maybe it gets pushed to 9.5, maybe it gets pushed there. But what I think is interesting is that chemistry kind of reflects the makeup of the sulfide, ore bodies in Canada. So if you look at the Turnagain deposit, and if you look at the Dumont, or even if you look at Ramu, the ratio of nickel to cobalt actually kind of reflects the battery ratio. And so to me, that also speaks to the need to potentially build more nickel mines, is because nickel is a great source of cobalt, especially when a lot of the potential new mines out there have a ratio that's kind of similar to where we're heading with batteries. So I think that's interesting, and people don't really think about that or talk about it.
So what nickel price would we have to see to incentivize the market to bring more of these resources into production?
I've been wondering that for a long time. I kind of thought we would see it here. I think, as I said, Goldman is running a process for Dumont. It's going to be really telling if they're successful or not, and who they bring in, what the partner looks like. If it fails, then I think that will tell you that we're not there yet. I have to think another dollar or two on the price, but we're already at a really great nickel price. It's more a function of opportunity costs and asset allocation and big funds. You're competing with tech, and you're competing with crypto, and you're competing with all these other investments. And so the risk reward kind of opportunity just isn't material enough, isn't exciting enough to draw money in, because like we talked about it a minute ago, a mine takes years and years to build and get the processing right. And so, right now, the big checks I see are coming from like Orion and those type of private equity funds who are trying to do streams and structured finance, but you still need equity. And maybe what that means is its price is going to have to overshoot. You're going to have to see a spike in nickel. The other part specifically for nickel is Indonesia. And I kind of believe that the market's probably waiting to see if Indonesia is able to supply a bunch more nickel into the market and at what cost. So there might just be an element of Indonesia and kind of not fully appreciating what's going on there and not believing the messaging. And so wanting just to see how it turns out. Now, if it doesn't turn out, the bad news is for everyone, that means we're going to lose, multiple years of potential construction on projects in Canada and other places.
Because at one point they had stopped exports of nickel out of Indonesia, right?
Yeah, they want it to be refined, and there's all sorts of games that get played there. And the Chinese are going to convert, nickel, using an HPAL process to nickel matte, and there's like 10 different narratives, and no one knows what's true and not true. And so I think that's confusing to the market. And in the meantime, if you're a fund manager, like, why try to understand the confusion when until 5 days ago, you could have just basically bought anything and it was going to go up.
Yeah.
And it'd be a totally liquid. I mean, remember, most mining stocks are completely illiquid relative to like some tech stock or some, S&P 500 stock. And, sometimes in our space, we kind of get a little bit like tunnel vision here, and we forget that capital is competing with everything else in the world. And so we have to be more interesting than whatever the other 20 opportunities are that, someone sitting in the seat has. And we just haven't been, and we haven't been for a decade. And as I said earlier, maybe that sets the stage for the big one, right? And just 5 more years away, like, who knows?
Mm-hmm. So do you think that we could see a major battery producer like Tesla, for example, go straight to the source and try to buy their own nickel or cobalt mines or resources to secure those raw materials?
Look, I mean, they've had the opportunity and not done it. Take the stream on Voisey's Bay, right? Okay, Cobalt 27 buys it. There were no battery makers. No one took it. Then Paula takes over Cobalt 27. No one steps up, stops that. And then Paula sells it on to, what's the base metal streamer listed on the LME? Julian Traeger runs it. I can't think of it right now. But, and so it got sold again. So that thing has been sold 3 times. And at any point, Tesla or Ford or anybody else could have stepped up and bought it, and they did it. And that means to me that either, they're so focused on their share price, the way that executive compensation works at those big companies, they don't care, or they don't know what the technology is going to look like, or maybe they just don't have the teams to execute that type of transaction. But whatever the case may be, the Western car companies just have not done it, or really, in my view, shown any real desire to do it, notwithstanding whatever public comments they've made. Whereas China, they've done it. They're doing it. They're doing it every day. They're buying stuff in Africa. They're buying stuff in South America. And I think it speaks to what their public policy is around electrification. And it also speaks to where they want to be. And where they want to be is a global leader in electric vehicles. They don't want to sell you a battery. They don't want to sell you cobalt. They want to sell you a car. Mm-hmm. And I think they're winning, and they're years and years ahead. And I can't really see that we're going to catch up unless we really start.
So if we see the nickel price and the cobalt price move materially higher, does this scenario present an opportunity for some type of substitution in battery tech if these manufacturers can't get the nickel or cobalt that they need?
Well, I mean, LFP is an example of that substitution, right? Like you can use an LFP battery. It's going to be cheaper. It doesn't recycle as well, but that'd be one example of substitution. we've already seen the battery chemistry evolve towards, an 811. So I think that's underway and happening. At some moment, based on the current technology, you can't take all the cobalt out. If you have a 10-year or 20-year view, I mean, anything is possible.
Mm-hmm. But the LFP battery is typically more for a shorter range vehicle at this point, right?
Yeah, it does not have the performance characteristics. So I don't think there's the answer probably is the car is just going to cost more. That's probably the answer until the price gets to a point where it's incentivized to build more supply.
Yeah.
Or technology changes. And, I'm unaware of any real technology that's going to be sitting in your new Ford in the next 5 or 10 years. After 10 years, once again, anything's possible, but we're pretty locked into these batteries for the next decade.
So, Anthony, when we think about jurisdictional risk of different projects around the world, does the actions of the Australian government recently pose a risk to the mining industry and projects there to you?
No, I don't think so. I think the biggest risk is just the cost of capital and nationalism and all these kind of trends that are happening globally. I think those are the big risks. Like, are we going to want to invest in X country if X country doesn't like wherever the capital is coming from? I think those are the type of risks, and maybe people don't want mines being built. And if you're really focused on being green, do you want these trees cut down? I mean, those are all risks, and they probably all speak to basic materials costing more. Yeah, I think that's probably what this all means. There's going to be some cost inflation in all these metals.
Excellent, Anthony. Is there anything else you'd like to mention before we wrap up here?
No, I just appreciate your time, Tom, and always happy to come on and chat with you.
Absolutely. Appreciate yours too. And, hopefully we can, bring a couple more eyes to this carbon story. This is something that is growing and the world is moving in that direction, obviously. Where can listeners find more about you? On Twitter, of course, you're A_Milewski. We'll put that in the show notes.
That's the best place. Twitter's the best place to get me, or LinkedIn, either way.
Okay, perfect. And Anthony, thanks so much for your time today.
Tom, thanks a lot for having me, bud.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.